So in 2025, I started this new portfolio where I add $1,000 a month into low yield, high dividend growth stocks to reach $100,000 in the next 6 years. So today we're going to take a look at the portfolio at a glance because I took a break during summer, not telling you what I bought. Then we're going to end the video with my next buy for September. All right, so portfolio at a glance, as you can see here, I am up 8% on it so far. Kind of normal. The stock market has been generous, so I benefited from it. The balance is almost at $7,000 with a very low yield of 1%. As I told you, I focus on companies offering me a high single digit to double digit dividend growth. I don't really mind the yield. I just focus on the total return. For the sector allocation, the portfolio is slowly taking shape with 5 different sectors at this point. We have very strong pro rating and very strong dividend safety score, of course, because we are focusing on quality here, not on the high yield or struggling businesses. I wanted to share with you where I'm at in terms of holdings. So I put them from the one that I'm making the most money right now. So almost a gain of $300 with Stentech, all the way down to a small loss of $100 with CGI. So over the past few months, I've spread about $1,000 every time into those different companies. What I really like about Stentech, I've been telling you about it for a while now. Very strong engineering firm, wide diversification, keeping their clients forever, and having a lot of chance of cross-selling. Now I made a play also on Franco-Nevada, which is a gold streamer. What I like about this one is, yes, it's a play on gold. It was a very good timing for it, but also that the fact that the company does not have any debt. Then I scooped some shares of National Bank, my favorite bank in Canada, not too long ago when the stock was trading around $120, which is a lot better right now. Even after a disappointing quarter, the market punished the stock, but still I'm in a good position to benefit from it. Then I added Dollarama, which is also a very long-term play and a defensive play in my opinion. So Dollarama, what I like about it is its ability to grow both by acquisition, because they just bought the Reject Shop, and not too long ago they also acquired more share into Dollar City. So they're growing outside of Canada like this, and they also benefit from organic growth by opening new stores and attracting more customers into their stores in Canada. Another defensive play was Waste Connection. Yes, it was trading at an all-time high. I don't mind about that. Even though the payout ratio is high, this company operates kind of like a monopoly where it serves waste services. So they go with contract, it's recurring revenue. And let's be honest, as long as we have human beings on Earth, we're going to have waste to manage. Finally, a recent buy was CGI, an IT service company focused on government contract, which I really like because it creates a very stable recurring source of revenue. All right, now, so are you ready to know where I'm going to put my next $1,000 for the month of September? Drum roll, please. All right, so I am going to add TMX Group, ticker X.to, to my portfolio. So TMX Group, it started as the Toronto Stock Exchange and grew throughout a long list of acquisition. It used to be a traditional exchange operator, and now it offers plenty of different services. So we're going to start with the playbook. Playbook for this one, well, quite simple. They have 4 different sources of revenue. The first one is Global Insights. Global Insights, what is it? Because it doesn't tell you anything, right? So they are selling data analytics and other information through a form of subscriptions to financial professionals. As an example, I run Dividend Stocks Rock to populate all the information for the graph, for the metrics, and so on. I have a subscription to a company named Whitechart, another one from Refinitiv that belongs to the London Stock Exchange. I could have also subscribed to the TMX Group with their different services as well. What I like about this part, well, it's all about recurring revenue, and once you depend on data to do your work, well, you're just going to renew your subscription kind of forever. The other big part of the business is, of course, trading and clearing. So 25% is about derivatives, and another 17% is about equities and fixed income. Derivatives are all the contracts. So you can think of options and futures, and most importantly, covered calls, right? They have been quite popular these days. Well, they are part of that trading and clearing for the derivatives. You have stocks and bonds as well under the equities and fixed income. And roughly what it does is that it makes sure that all the trades are being made and the assets are being in the right account and the cash in the other account as well in the other party. So this is how the clearing works. And they obviously charge financial firms for those services. And a good part of that is also recurring. The last part of it is capital formation. So you can think about IPO, for example, or products creation. This is where they're going to get the rest of their revenue. So long story short, they are dealing with financial professionals, financial institutions, and they are offering a lot of different types of services. The most important ones are how the stock market works. So the clearing, the trading, and the capital formation. And the other part is selling a lot of information related to that, which is great because they're sitting on it anyway. In terms of growth vectors, how can this business continue to grow moving forward? So they show a great mix of organic growth and growth by acquisition. So of course, the more people trade, the more product that comes in, the more IPOs, the more investors are interested about the stock market, then they will grow organically. On the other side, they can also make acquisitions to sell more information or to have different types of products inside their business. They have done several acquisitions in the past. It has been doing well. As a number of investors and the money invested in the stock market keeps on growing, it's just going to continue to grow organically. In terms of economic moat, well, when you run the Toronto Stock Exchange, you kind of have that monopoly in this specific target, right? And of course, if I'm interested into buying those information, well, that's going to be a very good place. So they have a relatively strong economic moat that is a great competitive advantage versus other stock marketplaces. All right, so that was quite a sexy narratives, right? A lot of growth vectors, a good competitive advantage, but how this positive narrative is translating into numbers. So let's take a look at the dividend triangle to see if it's a good pick for my portfolio. So as you can see, we have a huge jump in revenue and earnings right after COVID. There was a huge hype around trading that propelled the company, plus more acquisition for TMX as well, to a new high. At this point, you can see that there's kind of like a slowdown over the past 12 months, stagnating, going down a little bit, but I'm not too worried because they have still other projects. And as I mentioned, they have several growth vectors for the future. So yes, the stock price is trading at an all-time high, but my vision is not to make money in the next 3 months, but rather in the next 30 years. So that's why I want to add TMX on my portfolio. Unfortunately, nothing is perfect. TMX Group also have some kind of like very solid risks, and it is super important to weight the positive and the negative before you make a decision. This is what we call doing your due diligence. And again, this is not financial advice. I'm not your advisor, so I'm not telling you to buy TMX. I'm telling you to do your research so you can invest with more conviction. So TMX, what are the biggest threats? Well, we're going to start with business flaws. So in terms of business flaws, well, they're depending on the capital markets, right? So if there is a bear market, they're still going to make money. But if there's a fatigue where investors slow down their trading and then the volume goes down, well, then it's going to affect their profitability and their revenue as well. Another downside is also the appetite for the market for new stocks. So if there's a decline in new IPOs, well, then TMX is just going to make less money out of that too. In terms of industry and market threat, we have obviously the risk of seeing capital moving outside of the TSX, going into new type of products or new markets such as international markets or the US market. Speaking of money going in on the US market, there is a lot of competitor as well. And some of them might be interested in going into Canada. So we have now Neo Stock Exchange that created CDRs, very popular Canadian depository receipts. We have NASDAQ Canada as well. So while TMX is well anchored in the Canadian market, there's still competitors that comes in. And the other thing is, by definition, each stock market is in competition with the other. As an investor, I can decide to invest into Royal Bank on the Canadian market, but I could also decide to invest into Broadcom on the US one, and the TMX group will not get my money. So this is again a long-term play, and I know a lot of investors prefer to invest when the stock price are low instead of high, but for me it doesn't make much difference, because as long as I do a strong due diligence after that, I'm in for the long term. If you are confused about price moving up or moving down, especially during the earnings season, and not understand quite the reason why it's moving up or moving down, I do have a new webinar that is coming up this September 18th. You can register at moosemarkets.com/webinar. We're going to talk about how to review earnings in the proper way, how to identify the difference between noise and news, and finally, how to analyze stocks using the dividend triangle. So again, you can sign up at moosemarkets.com/webinar, and I'm going to see you next week. Until then, don't forget to stay invested.